legendary investor, Peter Lynch, once said, "Know what you own and know why you own it." In investing in stocks, do not go after what everybody's talking about. Invest in something that piques your interest and suits you best. Hey guys and gals, welcome to another episode of Financial Ventures. We are now entering a new phase in our investment series, and what better way to understand dividend investing other than by staying with us until the end of the video. If you like the content, be sure to like the video, subscribe to our channel, and hit the notification bell for more informative videos about finances. Remember, all you need is financial ventures in your life's adventure. You often hear people discussing what stocks to invest in and what other ways you can earn passive income. Dividend investing is always up on that list. A dividend is a payment that shareholders receive from a company's earnings. They can be compared to the way you receive interest for the money you put into your savings account. Or simply put, the company is rewarding you for putting your investment into their venture. When a certain company becomes profitable, the board of directors can designate whether to reinvest back the profits they earn to help grow the business more, or they can distribute those profits to their shareholders in the form of dividends. Two things when a company earns a profit: reinvest or dividends. As an example, if a company declares a 50-cent dividend and you own 100 shares, you will likely receive $50. This is because you will receive 50 cents for each share you own. Most often, the board of directors shares dividends with their shareholders if they know that they can't get a high return on investments by using that profit earned. They might as well give a portion back to their shareholders instead. As the trend suggests, mature and stable companies with strong cash flows typically pay dividends to their investors because of their slowed growth. Newer companies are more likely to reinvest and profit back into the growth of the business, and either way is acceptable. A basic understanding of dividends will not be complete if you don't go over when dividends get paid out to their shareholders. Companies and businesses are not obliged to pay a dividend, and they can stop it at any given time. So it is better to be aware that just because you own a stock, that doesn't mean you will get rewarded or paid a dividend. Stock transactions take a few days or more to be cleared, and that is to ensure accurate allocation of the dividends to their shareholders. With that being said, you have to be a shareholder before the record date. In that way, you can be a part of their cutoff period prior to the record date called the ex-dividend date. You basically need to purchase a stock at least a couple of days just before the record date so you can own it in time to receive the official dividend. The amount of time between the record date and the day the dividend is paid varies from one company to another. Some may take 1 week, and others can go as long as 6 weeks. In the US, they typically pay it off monthly, quarterly, or annually. Take note, the board of directors gets to vote on when they release the dividends, and if they are to release it as cash or reinvestments. When investors choose not to receive cash as dividends, they can always pick a dividend reinvestment plan, or DRIP. This allows them to reinvest the cash into additional shares, which makes them earn more of the fraction of the company and enables them to potentially gain compound returns over time. There are also other sources of dividends, not just from stocks. Index funds and ETFs pay dividends too. This will be based on the fund's net asset value, or NAV. This means assets minus debts. Either use the money to reinvest or pay down debt. You can always customize your index funds and ETFs according to your preference, but always make sure you purchase the right fund that will provide you with the right amount of stock appreciation. You can also purchase income bonds that will pay you dividends. In a general sense, with the bond you purchased, you lend money to the company or government entity in exchange for the government to pay you a fixed interest rate. And surprisingly, you can also get dividends from your life insurance policies. If the insurance company makes a good profit, it can always declare a policyholder dividend. Dividends are fascinating and enticing, but they also carry risks with them. The biggest risk is that dividends are vulnerable to changes in interest rates. In our current rising rate economy, several investors sell their dividend stocks and shift their money into higher yielding stock returns. With that being mentioned, dividends are not always a constant guarantee. They also greatly affect stock prices. When the public hears that the record date is approaching, a lot of investors will come rushing in to purchase a stock, therefore raising the value of that company. Once the X date is done, you will also see the downhill trend of the stocks as investors sell their stocks already after receiving fairly small dividend cash. Dividend yields will not make you rich, but it can provide you stability and passive income. It can enhance your portfolio's overall returns. Why is it safe to invest in dividends in this economic crisis? Simply because it boosts confidence and gives more comfort to the investor's outlook. It keeps them satisfied even when the stock prices are not rising. Dividends are still a good sign of stability and financial health. It makes sure that the investors stay loyal and happy by receiving regular income. Big-time investors predict a flatline stock market in the next coming years, and this made dividends more appealing to the investors. Before we end the video, we listed some of the best monthly dividend stocks you can buy to protect your passive income. The funds we will mention may provide stability, growth, and monthly income, but for a very affordable price. Apple, Microsoft, Exxon, and JP Morgan & Chase can provide you with a dividend yield of 2.5%. This is a good investment as they lead almost 1,500 largest holdings, which means that your risk is well spread and you can still get your dividend in time. We also have Boeing, United Health, Apple, and McDonald's. These companies belong in the top 30 large companies and have a dividend yield of 2%. The thing is, they're not well diversified as they are only sprinkled across 30 companies. We can also consider higher yielding dividend companies such as AT&T, Chevron, Philip Morris, Procter & Gamble, and of course, Coca-Cola. These are the companies that have good and higher yields of 3.5% because they are usually profitable, being the staple needs of the people. But the downside is it gets slower growth than the average company. You can never go wrong in investing in real estate. They have a dividend yield of up to 8% since they're usually the real deal in the investment setting. But it's not advisable to bet all your money on companies like Independence Realty, Stockland, and Chimera, since over the last 5 years, growth is quite stagnant. There are a lot more, but we want to let you guys know that earning a passive income makes everyone feel good. Even if they are small, at least it gives them the purpose that they own a portion of that company. They now have an extra layer of disposable income, or they can simply pay the bills on time. Determining your success rate in dividends may take some time, or can even take almost all of your portfolio. But remember, it is okay to ask questions and tips to be more informed. So feel free to comment down your thoughts below and suggest what else you want us to talk about. We hope to see you at the next one, and remember, it's better with financial ventures in your life's adventure. Be safe and make smart investment choices.